All right, guys, so we're going to finish our IUL conversation here today. And there's really two things that we didn't get into last week. So, all right. So we're into our illustration software. And just by way of quick review, let's open up the case we were working on, which was, I think, sample client, maybe. Is that what it was called? Here we go. All right, so we've got $250,000 death benefit. We've got $400 a month going in, and we've got that going in until probably we have age 70. Okay. We talked about all the indexes and interest rates and things like that. So we're just using the multi-index here. We've talked about the output design, where we're going to go through and primarily make sure we check this annual cost summary. And so I'm going to click calculate. And there's two things I want to play with here today. So if I show you this, let's start here. This is the non-guaranteed ledger. So first of all, without doing any customization, we're looking to see, is this a viable policy? Well, if you look down here at the bottom left, target premium is $2,600 a year. We're putting in $4,800 a year. So we're looking good there. The minimum is only $73 a month. So this is a well-funded policy. Obviously, we could put up to, it looks like $11,700 a year. So obviously a lot more room to grow. But there's a couple things I want to look at here. So if we scroll down and looking at age 70, we've put in $168,000. We're projected to have $476,000 of cash value. And then what we're doing is we're leveling off that death benefit. And I think we covered about that last time, because what we're doing here is we're increasing the death benefit right here from $250,000. And what's happening is we're increasing the death benefit by the amount of the cash value. That's fundamentally doing two things for this client. A, it's allowing them to put more money in. I won't bounce around, but if I were to change this to a level death benefit, my guesstimate would be, instead of being able to put $11,700 in a year, I bet it would be like $6,000 a year. It would be, much less. And this is also going to give inflation protection, because most people, if you think about real life, especially, if unless you're starting with somebody when they're like 65 and it's like an estate planning thing, that might be a different scenario. But I think in real life, if you had a person buy a policy and they had it for 15 years and they put $72,000 in it, it's got $91,000 of cash, and they passed away, and you got a level death benefit, and you go to deliver that death claim check, and here's your check for $250,000. Great, I appreciate that. What happened to our 91,000? Well, it's part of this 250. Wait, what? But that's not a conversation I ever want to have. And even though there's nothing unethical about that, it was how the policy is designed. In the early years of a policy, your cost of insurance isn't going to be much higher on an increasing death benefit when you're in your 30s and 40s, because on an increasing death benefit, we're paying for that full $250,000 of coverage every single year. And so just to bounce down here to the annual cost summary, if I look at this base cost of insurance charges, you can see that increase is just not relevant. I mean, we're at $300 and $400 a year, all the way into their mid 50s. It's really not until we get into their 60s and 70s that it starts getting a little bit higher. But even then, by this point, we're leveling it off. It's really low cost. You guys, Nationwide, one of their big selling points is it's a low cost vehicle. And so if I go back up here to non-guaranteed, I want to have generally as a baseline design, I'm going to have an increasing death benefit while we're funding the policy. In this case, it's still age 70. My opinion is age 70 is the new 65. When I got in this business, the 65 was kind of like the gold standard of retirement. That's when Social Security started. Medicare still starts at 65. Social Security started to, in my career here, has started to inch up, and it's going to continue inching up in age. Life expectancy is getting longer. Economic realities are going to force people to work longer. And so I think the average American out there needs to kind of have a benchmark mentality of working until 70. Obviously, there'll be exceptions to that, but that's kind of how I just illustrate all policies. That extra 5 years, by the way, makes an enormous difference. Look at this. Just in 5 years, it's an extra 21,000 or so of premium. But we're going from 333,000 of cash value to 476. I mean, you're almost making as much progress in 5 years as you did the 20 years before that. And so it's going to help a policy function better. It's going to help it illustrate a lot better. And here we are now, it's 476 of cash value, 726 of death benefit. And then in the software, I've gone in there, and we can go back and look at it, but I pulled up that grid box where we're adding a line, we're adding level death benefit from age 71 to max or policy, maximum time, which I think is age 120. So now you're seeing this death benefit freeze and level off at 726. But what's happening is that cash value is still growing inside of it. Because it's an IUL, obviously it'll never go down in value. It might grow bigger or less in year by year based on interest credits. But eventually what happens is the cash value gets close enough to the death benefit that it's starting to bump up that death benefit. Does anybody know what the gap between what this is called, what this phenomenon is called, where you have a gap between the surrender value or the cash value and the death benefit? Does anybody know the word for that?
Corridor.
Good answer. Kind of two interchangeable numbers or words. That gap would be called the corridor, and that amount of insurance could be called the base net amount at risk, or the amount of insurance that you're actually purchasing, or that the price is based off of. So once I start seeing this happen, by for sure, that's when we want to start taking money out of a policy. But I'd be good to start taking an income stream out even at age 71. So we're going to play with that here next. But I want to show you one thing. So there's two things we haven't gotten to: income streams, and we haven't talked about their conditional credit endorsement. So let's talk about the conditional credit endorsement. In fact, it's written right here at the bottom of these pages. It says, as illustrated, the conditional credit endorsement are met. Therefore, the accumulated values are increased by 20 basis points beginning in policy year 16. See details, blah, blah, blah. So let's go down here to annual cost summary. One of the reasons I love this page is this shows me every relevant column that I need to show a client. And so we're showing premium going in, we're showing that sales tax charge, the $10 policy fee. You've got the flat base fee for the first 10 years. You got the dirt cheap, cost-driven cost of insurance. There's no profit in this. It's just pure cost. And then we're showing over here the investment gain or loss on the assumption of that 6.42 rate, or whatever the rate is right now. And then we have end of year policy value, end of year death benefit. So I can I want to start with that non-guaranteed ledger in terms of presenting it, but then I can get to this page. And by the time I have a baseline of understanding of the moving parts with my client on the first ledger, this makes a lot more sense. And you guys, I'll just tell you, this is where I close all of my IUL, VUL business. It's this page right here, because when two things happen simultaneously, you're going to close business. I can't compliantly say every single time, but in my example, it's like 98% of the time. Okay. Number one, when the client understands what you're describing, and they can they get it, because people are not going to purchase something that they don't understand. They're going to walk out of your office, or they're going to get out of the Zoom meeting, and they're going to be like, thanks. Hey, we'll talk about it a bit. Or, yeah, it looks good. Yeah. Can I get back to you? And then they're going to start Googling and talking to people. And did you understand that? No, not really. Did you understand that? Not really. Like, you're going to be chasing your tail on that case forever. So they need to understand it. And there's an absolute skill set in going through this illustration in a way that you don't overwhelm the client with information. And then the second thing is, I think when you demonstrate complete transparency, that closes that trust gap, right? There should already be some trust because we're in a warm market in some capacity, whether it's a direct warm market case, a referral, a field training sale. There should be some connection there. But then when we demonstrate competence and transparency, it just removes. I had a case, Alec will know what I'm describing, but I closed a sizable VUL. It's now delivered, it's paid, it's done. And I mean, I probably had to work harder at that VUL than I've had to work at closing a VUL in a long time. And it wasn't a trust issue, but these people, like the longer we got in there, like they just felt like they had to understand every aspect of this product. And it was a bottomless pit of questions, right? Every time I would cover one thing, it would open up like 3 more like questions. And so we just went through illustrations again and again and again. But what was amazing is that the reason that case ended up closing was because all roads led back to the beginning. Like I never had to like clarify, not clarify. I never had to change something or be like, well, I know I said that, but I really meant this. Like I kept coming back to you. Remember when I originally said this? Remember when I originally said that? Remember when we talked about this? Literally, they called me last week because it's I don't want to go on too long of a tangent, but they had 2 questions up for me because they were signing the final illustration, you know, in the delivery packet. And one of the questions was, why is the death benefit increasing for like 19 years and then it stops increasing? And they read like on their amendment, it basically said like that was like in the policy design. And so I re-explained that very clearly. This was over the phone at this point. And I'm like, oh, okay, great. And I forget their second question, but it was along a similar line. And I could just go back to, remember we talked about this, and because I had such a clean, clear answer, they were like, okay, sounds great. Yep, thanks for answering the question. We'll sign it right now. And you guys, that's how business gets done. And so when I can show, hey, like let's open up the hood here and look underneath and let's look at all the moving parts. Let's talk about every single fee. And when you can just like put it on the table, and it's not like, well, don't worry about the fees. Most of your money goes to the cash value, which is what most of our industry tries to do, right? They're just selling features, advantages, benefits. I have that drilled in my mind. It's like a 90s sales tactic, insurance industry, like wholesaler. I still know the guy to this day. He's retired, but he used to come in our office. He was one of our big wholesalers, and he would talk about, let me tell you how you sell policies. You talk about features. You talk about advantages. You talk about benefits. And he had a zinger for everyone, and it was just all sunshine and roses and how great this product is. And it was just, that was his whole mentality. And you guys, that just isn't going to work most of the time. And so when you go through this and you go through the fees and you can clearly explain, people are like, okay, I get it. And then all of a sudden you go, and then on top of that, I'll do a takeaway with the client. I'm like, hey, so here we are, 10 years in, you've put $48,000 in, and your policy is worth $49,600. It doesn't look too exciting, does it? See, when I put that on the table, before they can like figure that out, or they start looking at it when they get home at night and they're like looking at this closely, like all of a sudden I take away the sting, and I'm like, just remember, this is a long-term investment. It takes a few years to pick up steam. I often compare this to a mortgage. I say, hey, you buy a new house, you pay a huge house payment every single month. You get your mortgage statement at the end of the year, and you've paid down 1% of your balance because almost all of your money has gone to interest. Not very exciting. But to borrow money at 3 or 4% for 30 years and write it off your taxes and have a home that appreciates and raise your family and all these things, it's one of the best financial vehicles on the planet, right? And so when I make that connection, if we look at a mortgage on a short-term basis, it's the worst financial transaction of your life. If you look at it on a 30-year basis, it's one of the best tools you've ever had access to. And so people are like, yeah, that makes sense. So we put that to bed, and then it starts getting a little bit better. Now you've put 96,000. We've got 149,000 in here. That's $70,000 of growth, completely tax-free. And then we go, you keep going down. So this is picking up more and more steam. And now people are like, okay, I get it, right? And I can't tell you how many people, by the way, that are 4, 5, 6 years into policies call me and they're like, hey, I had a question on this annual statement, or maybe we're doing an annual review and we look at it and you're like, it just doesn't seem like we've made a lot of money. You know what? You're right. You haven't. But let's refer back to the original illustration. I show them where we're at versus where we projected. Because market conditions have been favorable, almost every policy I have is performing a little bit better than projected. And the amount of confidence people have, oh, okay, I get it. Yep, I remember that now. Okay, great. Like, because that is where referrals come from. That's where long-term, lifelong revenue generating clients come from. And so let's talk about this conditional credit. This is one of the reasons why we like Nationwide. I covered, there's like 3 big reasons why I like Nationwide for IULs and VULs. You know, one of them is they just have a very low cost structure. And so it's helped me immensely on cases where, you know, that would be an issue, because I can come in and I can really demonstrate these are pretty low cost compared to mutual funds or annuities or different investment vehicles that are out there. Number 2 is this conditional credit endorsement. And what this is as long as you put enough money in the policy, and what enough money in the policy means is you basically have to put in a certain amount over the target premium, and it's a formula, and it's based on every policy is a little bit different, kind of like target premium is different on every policy. But the way you know whether you qualify for the conditional credit endorsement or not is simply based on the illustration. And so if you fund a policy just at target, you won't see any, you'll just see a bunch of zeros on here forever. And then you put a little bit more money in, like, boom, there it showed up. And so you can play with that and get that dialed in. On the VUL, it's actually 40 basis points. It's even more influential. But on this, you get a 20 basis point conditional credit endorsement. So what does that mean? Well, Nationwide's a mutual company. Does anybody know what a mutual company means?
Owned by the policy owners.
That's right. So they're a credit union where Transamerica, for instance, would be a stock company owned by the shareholders. They would be a bank if we used a banking parallel. So Nationwide basically is going to return excess profitability back to their policyholders, and the way they do that is this conditional credit endorsement. This is a guaranteed feature, meaning it is guaranteed on the contract. The reason it says conditional is because it's conditional on you paying enough money in the policy. In other words, they're basically rewarding policyholders that fund their policies appropriately, because that's a win for Nationwide. That's a win for the policyholder. It helps all of their mortality, and it basically everybody wins by policyholders funding policies correctly. And so they're going to reward you back with a credit. Now $200 a year on this case isn't going to change a client's life. But what's interesting, and we'll cover this on a VUL sometime, is that I show this and I say, now look at this. Yes, we have some higher level fees in the first 10 years. We talked through that. But in this policy, I often find on a VUL that the conditional credit endorsement is enough to basically offset the cost of insurance charges. Here, it's buffering them pretty dramatically. You know, here at age 60, you're paying $706 for insurance fees, but your credit endorsement that year is $436. So this starts making it a really low cost investment vehicle when you start comparing this to mutual funds or anything else. You know, and let's do that for a minute. And I'll do this on a VUL, but on an IUL, we're not getting dividends, so that's a negative. But you're also not paying an expense ratio. Of course, there's no risk of loss. But let's just say you're paying a 1% mutual fund fee on a $246,000 portfolio. That's basically $2,500 in fees. Here, you're paying a net of $220 or so in cost, plus a $10 maintenance fee. I mean, it's like 1/5 the cost of a mutual fund and none of the risk. And so when you start comparing things and helping people have some anchor points of putting this stuff in perspective, that's when you win a lot of trust. That's when you win a lot of credibility. And this just demonstrates, hey, I have nothing to hide. Like we're shining a light on every fee, every cost. Because Mr. Client, the better you understand this, the more confidence you have in this, I think it's better for all of us. And so that's what the conditional credit endorsement is. And that's going to continue for the rest of the life of the policy. And you can see it's basically, actually, it crosses the base cost of insurance because we level that death benefit off. You know, and that policy is based on the cash value growth. It becomes pretty powerful. Now we're going to show an income stream here in a minute, start taking this cash out. But any questions on that endorsement credit before we move on? You guys, I have scored some huge points with kind of on the fence clients with that right there, that feature. When I compare and contrast that and show the value of it, it's been a huge like, wow, that's really cool. So now let's go back and do one more thing. So I'm going to go back up here to this non-guaranteed summary. So we're funding this through age 70. So we put 168 in, 476 of cash value, 726 of death benefit. So we can start an income stream here now. In general financial planning, because this is, there are two features to this product that are going to make it very unique in a client's life. So if we assume this client also has 401k money, IRA money, maybe some Roth IRA money, maybe some brokerage accounts, you know, they have some other stuff by the time they hit 70 in life. You know, there's two aspects to this account that they can't replicate anywhere else. And certainly not at this cost structure. Number one is going to be all of this will be tax-free income compared to taxable distributions from IRAs and 401ks. Number two, this is a source of income where the principal is absolutely guaranteed, which makes it very predictable. If we know we can't lose money and we know what the internal costs are, we can be pretty dialed in with the income stream we take out of it and really have a nice income supplement to their retirement. And so saying that, I often will tell clients, hey, you know, there's going to be a lot of things to address in 15 or 20 years. So let's say the client is, you know, 20, 25 years away from this. Who knows what our economy looks like in 20, 25 years? Who knows what our tax rates look like or what major changes we have? Who knows what Social Security looks like? So there's way too many variables to like get too regimented on one thing. But I will generally tell people that the bigger a taxable asset grows, the bigger the tax liability grows. So if you look at a 401k, you know, there's a growing school of thought that's becoming adopted in financial planning that, you know, you have to take RMDs now at age 73. But most advisors say if you don't need the money, you shouldn't necessarily wait to 73 to start taking income out of your 401ks because you're just exponentially compounding your tax bomb liability once those things kick on. And so if you stop working at 63, 64, 65, and you have 5, 6, 7 years there where maybe your stuff's all paid off, your income needs are less, so you're not saving anymore for retirement, you're just living on less income. Those are optimal years to start taking money out of qualified plans. You have what's called an income trough and paying taxes at low rates, filling up those low tax buckets and letting your tax-free money, your life insurance and your Roth IRA money keep compounding. And so generally I would say, you know, from age 65 to 70, let's really hit the 401ks and IRAs heavier. And let's let this money keep compounding. So every case is different. So you can make an argument that we might wait till 75 on this thing, but let's just start at age 70. So the way I do this is there's some solve functions you can use. I never use them because I think that can lead you down a kind of a road where it may not be realistic. I just keep it really simple. And I'll look at this policy and I say, okay, if we have $500,000 here that can't lose money, if this was in a brokerage account that could, we're probably taking out maybe 4% or so of that value if they need an income stream every year. Maybe 5, but probably 4. But here the average assumed interest rate 6.42. We don't know if we're going to make that every year, but we know we can't go negative. So at least for simplicity's sake on the illustration, I have to account for some expenses continuing to come out. But we could take 5% out of this for sure, maybe even 6%. And basically not run out of money because we have that interest coming in. Now, this is an illustration, right? So I'm not like guaranteeing my client's going to have this income because this is based on a bunch of assumptions 30 years from now. But just as a ballpark, 5% of $500,000 would be 25, 6% would be 30,000. So that's about where we're going to start. So if we go back over here to case design, and let's go to interest rate and income. We scroll down and we go down to income here. So it says distribution amounts, declared rate. We have a few different options here. So what we want to do here is I want to click this little calendar box, or it's probably a calculator. And we're going to punch in the amount of money we want to start. So let's just start, let's start high, and then we can work our way back if we need to. So I'm going to punch in $30,000. We're going to choose withdrawal, then borrow. What that means is we're going to withdraw their basis or the total of their premiums first, which is a tax-free distribution. And then we're going to be left with policy gains. And at that point, we'll automatically switch to policy loans. And we're going to start this at age 71. And we're going to go to age, you can go to 100 or age 95. Let's start with 100. And then we're going to click calculate. And let's just see where we're at. So if I scroll down here, first of all, if the policy failed, it would have given me a warning there. So we have $30,000 a year coming in. And so what you're seeing here is there's total loan balance of 0. That's because we're not taking a loan yet. We're withdrawing our basis. And it's taking us a full 5 years to pull out, 150 of our 168,000 in basis. So in that 6th year, we're pulling out the remaining 18,000 plus $12,000 here to get to the 30,000. We come over here, and now the column. So when you're in the accumulation phase on a product, once you get through the surrender charge period, if I go up here, accumulated value and surrender value are going to be the same number. And so you can kind of use either one interchangeably. But once you start taking income, you're going to notice a difference. You're going to notice that accumulated value is a higher value than the surrender value. So once you start taking income, surrender value is the value you want to focus on. That's your net cash in a policy. Accumulated value is going to account for the cumulative amount of money you have out on a loan. And so if you do the math on here, if you look at total loan balance is 141 and you add that to 475, you're going to get the 617. So basically, your net numbers are always, once you start taking income, going to be the surrender value and the net death benefit. Notice it doesn't say death benefit, it says net death benefit. So the net death benefit is still going to maintain, but look how efficient this is, guys. There's literally, you're paying for like $50,000 of insurance here at this stage, which is making all of this tax-free for the rest of the client's life. And so you can see at a 6% distribution, because of the math on this, basically you have 6.42 growing, but you also have that 20 basis point conditional credit endorsement. So you essentially have 6.62. So basically, because that number is a little bit bigger than 6% after the fee, that's why you're seeing this net surrender value being very constant. And then as that cost of insurance starts getting bigger in their 80s and 90s, you can see this net surrender value is dipping just a little bit, but this is very steady. So this tells me right here, this is a pretty robust illustration. The reason I don't like the solve functions is it's going to basically solve for the max amount of income you can pull out. And so it's going to basically take that death benefit. It's basically the idea of spending your last dollar on your last day at age 100, which I want to leave a lot of buffer. I would much rather under promise and over deliver than have my clients walking in my office thinking they're going to have $100 grand a year of tax-free income when they're 65, and then all of a sudden they find out it's like 40, And so what we're doing here is, I think at 6% on an IUL, I'd be comfortable with this. As long as I'm not seeing this death benefit really deplete, I think we're good. You'd be shocked, by the way, if we go back, and it's worth showing you. if we do just a little bit more, how big of a difference it makes. If I go in here and I go to 35,000, so now we're at basically a 7% distribution rate. And I click calculate. Looks like it still works, but let's see what we end up with. Yeah, so at age 100, you're down to $17,000 of surrender value. So we made it by a whisker, right? So that shows you the exponential difference of just a little bit more income, right? Once that boat starts taking on water, right, it just progressively gets worse. And as those costs of insurance fees, why look what's happening here. Look at this surrender value just gapping down. You know, that's the danger there. So now the opposite is also true. If I put 25,000 of income, you're going to see a ton of growth in here. And so I really don't want to illustrate that either. I want to kind of hit that sweet spot of maintaining the cash value, just taking out the interest. So you're going to find on a lot of cases, 6% is a good way to do it. But then the last component, let's go back here, would be I'm showing a level income. So if I go back here to this, let's change this to 30,000. Let's click this advanced tab here. And now if we click advanced, you can do increase. And so increase might be, let's say I do a 3% increase. Now this is going to probably blow it up. Click calculate. Now we're starting at 30,000, but that didn't, oh, that increased by $3 a year. Let's go back. I wonder if I go 3%, what that does. And it said policy has lapsed. So let's look at it anyways. So if I wanted to show an increasing just like Allianz, I probably need to start at a lower number. Because now this is showing, you know, 3% increase. So now we're at 40,000 income, 50,000 of income. We still make it to 93, taking out 57,000 of income. So I'd probably continue playing with this and start at, you know, 5% or 4.5% and whatever. And I think you go either way on that. Sometimes for simplicity, knowing that this is 30 years with a ton of assumptions, I'm just going to do a level death benefit to demonstrate the concept. Sometimes I might get a little bit more detail with an increasing death benefit, or I'm sorry, an increasing income stream. But those are kind of all the variables you play with. And so, you know, one of the reasons you need to get in the software and play around with this and then hopefully put it to use in a real life situation is two things. You fumbling around with the software yourself and doing a little trial and error like I just did is how you really learn it. And then when you get it involved in a real client scenario, that's what binds it to your brain. When you can connect concepts to reality and real situations, you just have a way of retaining that information a lot better than if it's just all conceptual. And I mean, I've sat through so many wholesaler lunches and meetings and presentations, and it just all blends into one like conglomerate of like charts and graphs and talking points, but I don't really remember much of any of those things. But I remember specific details about all kinds of client cases I've done, you know, years later. So I think we've kind of hit IUL. Are there any questions as we're wrapping up here today?
I have a couple. My first one pertaining to like the income piece of this is more of kind of like future, your opinion. Once someone's getting to this stage of taking income 30, 40 years from now, like, is that something that we should be planning to, like, are we meeting with them annually, or like, do we set up a form and set it, forget it annually, or like, what does that look like in our business? Or do we need to worry about that in 30 years when the time comes? Because our industry could be radically different.
I think it's more the second rather than the first. I mean, what policies and procedures will always change, but you might teleport or something, or do a hologram meeting, but generally speaking, you're going to need to get some sort of paperwork signed with banking information, and but functionally, it would be like no different than setting up an income stream from a Goldman Sachs account or a variable annuity. You're
Yeah.
just gonna like you can say absolutely, you can set up like a monthly distribution via loan, and yeah, all those options are available.
Yeah, I just didn't because I haven't reached that point yet with any client. I didn't know if that is like something to factor in, like how this comes out or how we should be presenting it to somebody. Um,
Alec, in 24 years, I've never had anybody ask me that question. Like what form is involved in doing this? Is that
yeah,
kind of what you're asking?
not like, yeah, no, not that specific. Just like how we should be presenting, like, hey, when the time comes, like that's when we'll figure out what income. I don't even know where I'm trying to get at this point. Like I had in mind, and then it came out loud, and I don't know how I'm like trying to word it, but I
Yeah.
know up here what I was trying to ask.
Okay. Yeah, you can take income from this on, just like any kind of variable annuity, any kind of fixed annuity, any kind of, managed account. It's just, you can set it up on autopilot, direct deposit to a bank account, no tax withholding because it's tax free, all that stuff.
One comment question I had, which probably lends itself into another training. I don't know if you're going to stay on IUL or go to VUL, but really, I think where you've left off here is how does this compare to what else is out there? Whole life is obviously a predominant product still being sold, with similar loan and withdrawal type setups. How does that compare to a
I actually
tax?
think that's a great training for next week, because what we can do next week is I'm going to take what we've done here. We're going to pivot into VUL. That'll be a pretty quick piece because it's really just swapping out engines, and the vehicle's the same, everything else is the same. But I think in that same conversation we can talk about, functionally all permanent life insurance policies are designed the same, or work similarly. They all follow the same tax code with the same structures, but the moving parts are a little bit different. And so we can, I think, in one conversation talk about IUL, VUL, whole life, for that matter, universal life, which is really splitting hairs. But yeah, for absolutely, we could talk about that stuff, and I think it'll be a good conversation to kind of wrap up permanent life insurance altogether.
Perfect.
Hey guys, hopefully we've added some value here, and let's put the stuff to use, guys. I think there's a lot of clients that we can get into next week as well. There's a lot of clients out there that can benefit from some of their coverage being permanent, some of their coverage being term. There's obviously some specific use cases to just permanent. A lot of situations where just term makes a lot of sense, or is most prudent. And I just love the fact that we have all these tools, and every situation's unique. It's not like I'm a pharmaceutical rep here selling one, medication to every doctor's office I can get myself into, right? This is the solution for everything you got, as many patients as you can get this to. I just have all these tools, and I can sit down with each individual client and put together a tailored game plan. And it's just been an awesome career to have, and I want to have you guys do the same. So let's wrap it up there, and we'll be chatting with you guys next week.